You're looking to purchase a home. You're seeing a lot of information out there, and one of the most common myths is you need 20% down in order to purchase your home. So I'm here to tell you and dispel that myth that it is inaccurate. You can actually purchase a home with less than 20% down. And what happens, or what's the difference between putting 20% down or less than 20% down, is PMI, private mortgage insurance. When you put less than 20% down, your lender will require PMI on your loan. So PMI is the additional insurance policy that's required on top of your principal, interest, taxes insurance. It is calculated based on your risk factors. So giving you an example, if you're an excellent car driver and you're looking to buy a new car and looking for a new insurance policy, based on your driving record, that insurance policy or that insurance premium will be lower the better your driving record is. Same thing with PMI. PMI's risk factors are determined by your credit score, your down payment, and your debt to income ratio. So, to give you perspective and remind you the tiers on credit, it starts out with credit scores of 600 to 640, 640 to 680, 680 to 720, 720 to 760, and then 760 to 800. Now, when you have a credit score of 740, 760, or 780, or in that range, it's considered to be excellent. When you're below 680, your credit score is considered to be average, or below average when you get to below 640. You will have your PMI rate higher depending on that credit score. Then you take the second factor into place, your down payment. PMI is calculated with increments of 5%. So if you're putting 5% versus 10%, your PMI rate will be higher with 5% down versus 10% down. If you were putting 8% down, your factor is still based on the 5% factor versus the 8% factor. So it goes with increments of 5%. And then the last piece is your debt to income ratio. The normal requirement of what's considered good and reasonable debt to income ratios is under 43%. So your total income, your outgoing expenses, not to exceed 43% of that income. So if your debt to income ratio is below 43%, that is also a good PMI calculated risk factor. So if you have a good down payment, good credit score, and low debt to income ratio, you can expect uh, a very low PMI factor or PMI monthly insurance premium as compared to if you have a low credit score or a lower down payment and a high debt to income ratio, then your PMI factor will be higher. So what are the types of PMI that is available? There are several, but the most common that I'm going to spend the most amount of time on is borrower paid PMI. Borrower paid PMI is a factor multiplied by your loan amount, and that factor is included as part of your monthly mortgage payment. What's great about that, there's a lot of flexibility in borrower paid PMI. It falls off when you pay the loan down to a 78% loan to value. If you pay it down to an 80% loan to value, you can request your lender to make a manual adjustment on PMI to have it removed. There are other ways as well to have your PMI removed earlier than the expiration of PMI, or waiting for the PMI to gradually come down to a 78% loan to value and then fall off automatically. You can get rid of PMI by paying down your loan faster. So you can make accelerated principal payments. Or if you choose to renovate your home, you can show the cost of the renovation and ask your lender to send an appraiser out to the property to see how much appreciation you've accumulated based on the renovations. Now, if those renovations get you to over to where you are under an 80% loan to value, your PMI will fall off because of those renovations. And then the third way to remove PMI is to refinance your mortgage. If you choose to refinance your mortgage and you've accumulated the 80% or the 20% equity and you have the 80% loan to value, you can choose to refinance your loan, get rid of the PMI, simultaneously change the mortgage option. But that is also a refinance situation, and you can decide if that works for you. The second type of PMI that's available is finance PMI. What that means is that your lender will determine what the cost for the PMI is. You can choose to pay it as part of your mortgage and finance it into your loan. So, for example, if the cost for the entire PMI for the term till you get to the 78% loan to value is $10,000 and your mortgage is $500,000, you will include that $10,000 into your loan, and your monthly mortgage payments are based on $510,000. What's good about that is you don't have a monthly PMI payment, so it really does help cash flow. What is the con about that is that you're actually paying that upfront as part of your loan amount, and you don't get that reimbursed back to you. So if you choose to pay your PMI off faster, that is really a sunk cost. The third option is split PMI. You as the borrower can ask your lender to give you the option of paying 1% of your PMI upfront, and you can pay it as part of your closing cost, and then the remaining that's the cost for the insurance, paid on a monthly basis. The benefit of that, it causes your PMI rate to be lower on a monthly basis, and it really does help your monthly mortgage payment. I like that option as well because it really does help you maintain your cash flow a little bit better. But once again, you're paying that 1% off as part of a closing cost. So it is a closing cost that is incurred and does not get back. Then you have the mortgage insurance premium when you take an FHA loan. In an FHA loan, PMI is called MIP, Mortgage Insurance Premium. Now, there are two parts of MIP in an FHA loan. It is upfront and finance on a monthly basis. The upfront percentage is 1.75% of your loan amount that's financed into the loan. And then, depending on your down payment, your monthly can be anywhere 0.50 to 0.90 of your loan amount. And that's an added insurance policy that you pay on a monthly basis. All these PMI options are great. The reality of it is that it actually allows you to purchase a home with less than 20% down. There are options where PMI can be tax deductible. There are options where you can get rid of PMI sooner than later. If you would like to explore this a little bit more in detail, or anything at all as it relates to your home buying process or home financing process, you can DM me or call me on my cell phone, 201-745-3426. Thank you and have an amazing day.